do always start off the show with a summary of what was happening in the market. We kind of divide this, concept of retirement into three pieces. From the financial side, there's lots of other pieces of retirement with health and, family and all these things, travel. But from financially, it's really asset management, right? And how to do the retirement planning and the tax planning. So this is about the asset management. We're trying to kind of educate what's happening with the market and what we see and how we're responding. Right now, we have 75% of our normal exposure to the stock market. So if you're 100% stock, then we're 75% in. If you're 60% stock, I think that works out to something around 48% or whatever that is. But and so we're still holding back some, but there have been some significant things that have happened here, even just this week. And so if you look at that red line, this is the S&P 500 from the all-time high, which was the 4th of January last year. And you can see we have pretty consistent touches across that red line on the high side, each time failing to get through, falling back down to some new lower low up until recently. And so there's kind of a checklist. What we want to see is a primary trend that is up. We all like that. It's a lot more fun, in my opinion. And right now the primary trend is down. And so there's some things that we look for to see that move. And so I'm gonna look a little closer. Here's a 5-minute chart of this week. And so you can see the red line is right there. We kind of jumped through at the beginning of the week. And then actually on the open after Microsoft's earnings reports, we opened below but still got above it before the close. We've actually had, if today holds up, which it looks like it might, we've had 5 days in a row we've closed above that trend line. That's really important. So the checklist is fairly straightforward. 200-day moving average. And we've got above that several times. It failed, but we're above it again. Mm-hmm. Break that trend line. There we go. So far we broke that trend line. And then if I go back here, a couple pieces that come from Dow Theory. So Dow Theory, again, the Dow isn't just an index. It was actually a gentleman by the name of Charles Dow. And he started the Wall Street Journal and did all kinds of different research. But one of the things they talk about is primary trend and the way that a primary trend will go from, in this case, down to up, which is what we want to see. And the criteria that they use inside of Dow Theory is that you want to start to see a low that isn't lower, but higher. So, for example, if you look earlier in this chart, all those lows are pretty much lower, 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 but this last low was higher than the October low that we hit. Good. That's another check mark. Then the next thing you want to see is higher highs. Obviously, I haven't seen that all the way down that red line. All the highs have been lower. So right now, if you look closely at this, the high is around 4,100 for this last little run up that ran right up to the red line. We're at 4,093 right now as we speak. Almost there. Now, we bounced off of that twice. There's definitely some resistance there. So don't be surprised to see some pushback at that level, some selling and what have you. But if we can break above that, close above that for a few days, again, you got another check mark there. The only question I have is that's sort of a strange high, the way that it worked out. The one that's very definitive is the one that came in the summer. That's the high before this, which is 4,300. Mm-hmm. And certainly if we get above 4,300, then on a pure technical basis, the primary trend has changed. It's gone to up. And I'm not saying that's going to happen. It's going to fall apart from here. I'm just saying that right now things have been technically moving in the right direction. No ifs, ands, or buts. And this is a fairly powerful move if you really look at it from a granular standpoint. It looks very, very good. There's a lot of positive green all over the charts. We did have this before, back last summer, so who knows. But this is exactly the opposite of what was being expected in the first quarter. Expectation was that earnings would be bad, forward guidance would be bad, mm-hmm. Stock market would drop and come down quite a bit. Everybody's kind of in different ranges, but 10 to 50% is kind of the range for a majority of the articles that I'm seeing out there. This is what was supposed to happen the first quarter, second quarter of this year. Still might happen, but we're going exactly the opposite direction so far.
Yeah, a contrarian take would be quite profitable.
Yeah, exactly right. And sometimes, again, everybody gets on one side of the table, and it goes the other way because it doesn't take that much to push it the other way. When all the institutions are out and they've lowered their stock market exposure and they sold as much as they're going to sell, and the individual investors come in, which I think is what's running right now. Because if you look at what's running right now, it's the same things the individual investors were pushing in 2020 that's doing well right now. And so they have enough power, even though they're not as big as the institutions, if the institutions sit on the sidelines. So these are good things. We just got today, let me switch this so we can see this a little better. We just got the PCE index, expended PCE index report. It's the personal consumption expenditure. And what this is the preferred measure of inflation by the Federal Reserve. The only disadvantage of this is it reports really late. I mean, here we are late, as 27th of, it reported today, the 27th of January, and, it's reporting for December. But this is what the Federal Reserve is looking at. This is what they call the top line, including energy and all those different type of food and such. So it's down to 5%, which was better than expected. Excellent. We're getting trends going the right direction. That looks really good. If we look at core, okay, now this is key because the core PCE, when the Federal Reserve talks about getting inflation back down to 2%, they're talking about core PCE, not 7% or whatever it is right now on the CPI, 6.7 or something like that, getting that down to 2. I keep seeing articles about that. That's actually not what the Federal Reserve has said. They're trying to get this back down. So we're at 4.4, closer, right? But that needs to continue to come down. Lots of things to go on this and see where this ends up and what have you. But the trend recently is certainly good. Today's report was good, better than expected. So excellent. And then a couple more measures of inflation that we always watch. This is the Fed funds futures market, a projection where the Fed funds might peak, in this case by July of next year. You can see that's actually come down some. It was expected to get to 5.1, and now it's down to 4.9, which is almost exactly what is expected by the market in terms of 2 more quarter point increases. One next week. Federal Reserve meets next week and Wednesday on the 1st. And then one in March.
Yeah, you were telling me that the market's predicting like 99% of chance.
99.1% chance of a quarter point increase. And so, and there's been quite a few interviews where they've talked about it being okay with a quarter point increase. They're trying to set the table some there. Now, the market is running, and the Federal Reserve doesn't like that right now because it lightens up money supply. It releases money supply. People feel like they can spend. That's an inflationary event. They're trying to get people to do just the opposite of that. So we'll see what they have to say next Wednesday. So sometimes they use their rhetoric. One of the nice things this week is that they're in their blackout period and they can't run around and bring the market down with all their commentary. And lo and behold, the market keeps going up. So I like these blackout periods, but nonetheless, that's what's happening right now. Another measure of kind of the inflationary issue is the 2-year Treasury yield, right, which is also doing well, kind of peaked out, more or less on a downward trend, or at least sideways. So the inflationary pressure is relatively low. CPI numbers, core, non-core, top line, whatever you want to call it, PCE number, everything is showing that inflation is starting to get better. So that's good. And so that's kind of I think one of the catalysts that's definitely helping the market. Tech stocks respond very heavily to this 2-year yield. When you see it come down, you'll see tech stocks doing better, and the Nasdaq's definitely outperforming the S&P 500 recently.
You can see the tech, like SOX has been running real heavy this week.
Yeah, semiconductors are doing really well as an index, even though some of the companies like Intel reported some pretty poor results with poor future outlook. So it's really kind of fascinating to see how this is playing out. But this is what has happened on a quarterly earnings basis for the S&P 500. And this is, bottom up EPS, earnings per share. Actual is the dark, blue. And, estimates are this light gray. So this first light gray one is the fourth quarter. You can see it's expected to be less. Matter of fact, this will be the first year-over-year quarter where we've had less since the third quarter of 2020.
Yeah, 2020.
Yeah. And so earnings are down. And actually, if you really dig into earnings and look at what's going on, I'd say they're mediocre across the board. And they're expected to maybe even come down a little bit more, next quarter. And so this is where all of these big analysts are talking about, and they're saying that the expectations, all those gray bars, are too high. And that as the companies start to report earnings, they're going to say, okay, our forward guidance is lower than what's expected, and all those expectations come down, and the market responds to that and starts to ratchet down. And then we end up with kind of a free fall type of scenario. We get that 10 to 50% drop because of that. So that's what's happening. And that's why, if you look at this, they're still saying that these are too high, right? Now, what's interesting so far, 29% of the S&P 500 companies have reported, right? 69% have beat expectations. Now, that's less than the 5-year average. 77% normally beat expectations. But that's higher than what was expected this time. Yeah, there was expected to be bad, and it's more mediocre. Mediocre is better than bad, right? And that's kind of what's happening here.
Yeah, but we're still early in the earnings season. We're only about a quarter of the way through. So next week we're going to have some big tech companies report, and that could be really changing the market.
Yeah, well, these 2 weeks are really kind of the litmus test pieces because the companies are so large. They have big impacts on the indexes themselves because these indexes are weighted by size of company. And so they're fairly important as far as that goes. And yeah, exactly. It's still early, but I'm telling you, in terms of what was expected, there is at least a fairly decent mixture. In that 29%, we've got the banks, we've got some tech companies, we've got some consumer staples that have reported. And so there is at least somewhat of a mixture. I'd be a little bit surprised to see it be wildly different for the rest. There's bound to be something, though, that where somebody really misses and has some negative things to say. But this is one of the most surprising things I've seen. And this is based on, if you look at a stock, they report their earnings and they have a positive surprise. So they beat, the expectations. If you look at the 2 days before and the 2 days after the earnings report, the average return so far in these reports has been up 1.5%. Average 5 years, 0.9. So it's rewarding companies that have a positive, result for earnings per share at a higher rate, which is interesting because this is supposed to be a terrible scenario. But what's really fascinating to me is even if they have a negative surprise, they come in under expectations, they're still making a positive rate of return in that 4-day period, 0.7% versus negative 2.2. This has to do with expectations being low, and even though it's mediocre, it's better than bad, and people are responding to that, and the stock market is moving in that direction to kind of come back up. And at some point in time, people start to cover their shorts, and then other people see this market moving and they're jumping in because of the fear of missing out. And, so we've had a nice rally off of that as far as that goes. So that's what's going on with earnings. So inflation seems to be, moderating again, still good. Looking at the different indicators for inflation, they look okay. The market is past that trend line. It's kind of met a lot of criteria for a trend change, still a ways to go. And then earnings are really probably better than what the overall investment community figured. And that's why the stock market's been going up. A ways to go on that. We'll see how that plays out. And we really need to also get through the second quarter, see how this plays out. But one of the fascinating things that I don't think is getting enough press, so to speak, is the situation in China. And so this is an iShare China index. And it buys a lot of the stocks on China. And we don't invest in this directly ourselves. I'm just showing you this for reference points. This is also from kind of the top, the beginning of last year to now. And this run that we're having in the stocks in China is ridiculously going. And the biggest reason is because of the release of the zero COVID policy. And so this could have fantastic impact on the markets because what's happening here, second largest economy in the world, is been tamped down for 3 years. I mean, really locked up. Their lockups are not like what we had here in any stretch of the imagination. And so you've got this huge pent-up demand. it is going to be moderated up front here by the fact that the virus is running around like wild.
Yes, China's reported 80%, eight out of every 10 people has been infected so far with COVID.
Yeah, exactly. And, it's not surprising because this version of COVID is very contagious. Maybe not as lethal, which is good, but very contagious. Expectations is that the virus will run through the entire country in 6 to 9 months. The different epidemiologists, that's what they've been talking about. So that's going to be a difficult scenario to deal with, especially for their healthcare systems and those types of things. So hopefully that works out well. But the market is a forward-looking mechanism. It looks forward 6 to 18 months. And it's looking forward to the period of time when China is past that COVID wave, so to speak, and that group starts to kind of come out of their shell and starts to travel and spend. And the pent-up demand that we've seen in the Western world that's really created some of these big, spends on travel and hotels and airlines, all those types of things. We're probably going to see another big bump out of that as China comes out and starts to get back into a normal scenario, a more normal scenario as far as that goes. So the reason this is important is because the big fear right now is that there's big recession coming. We're going to have these big drop downs in earnings more than expected. The market hasn't accounted for that. The market's going to fall because of that. But on the other side, you have China coming out of its shell. There could be a mismatch in time because we're talking about recession and earnings problems kind of right now, first half of the year. China's still got the COVID wave coming through, so it could take them a while to really get going. So there could be a little mismatch. But again, the market's factoring this in. I feel very strongly that upward trend right there that we're seeing somewhat relates to what we're seeing in our stock market here. Because people can see that China can keep us out of a steep recession, theoretically, potentially, right? Now, the other weird thing about this and the really strange thing about this whole environment is that China could also reestablish a higher inflation rate as they get out and start to spend. They're one of the biggest users of energy, so we could see energy prices increasing as they get going again. And so, services are the big area where we've seen inflation. And so as they get back out there and start to spend on those areas, at restaurants and what have you, and travel, we could see some inflationary pressures, which could be, so that's the weird part about this. One thing looks good, hey, that helps recession. The other side, it looks at it and say, okay, that could be inflationary. So we'll see how that plays out. But I do think this is a story that's not being talked about enough, and how much impact this could have on the markets as a whole, as a global market, to keep us out of some of the more severe recession scenarios that have been kind of played out there. So very fascinating how all this is working out. This is a historic time frame, and watching the markets now and understanding how they work, you're going to learn more in this time frame, 2020, 2021, 2022, et cetera, than you might have in any other 3 or 4 year time frame, just because, again, we've got these dynamics that aren't normally there. And so anyway, I think this is one of the things that is making people excited about that possibility of less recession, and maybe less impact to earnings, and that could help quite a bit. So anyway, that's our outlook for our situation for the last week. Again, we'll look forward to covering that again next week with you. A great time to be watching these types of things. So